Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about how to engage in velocity banking with the credit card. So before we go into this and actually do the actual calculations, let's just do a quick review of the differences between, let's say, a credit card and a line of credit. So first, let's review the concept of a line of credit. So a line of credit is a financial tool where you borrow money, you pay it back, and then you can reuse it over and over again. Whereas with a loan, you borrow money, if you pay it back, you can't use it again unless you get a new loan or you refinance. So here, my example says you borrow $1,000 today, pay back $1,000 later in the day, and then you can use $1,000 tomorrow. So again, the idea with the line of credit is that you can use it over and over again, no issues, unlike a loan. So there's two types or several types of lines of credit. So you may have heard of a personal line of credit. That's just a line of credit tied to your name. Business line of credit tied, that's the line of credit tied to a business. Home equity, that's a line of credit tied to the value of your home minus any loans that are in there, like a mortgage. And then there's a credit card. So even though this type of product has the name of line of credit in it, a credit card is also a line of credit because if you swipe 1,000 today, pay back the 1,000 later, you'll be able to use 1,000 tomorrow. So, however, there are some nuanced differences between this and this. So we'll just kind of go over that right here. So a credit card in general will have higher interest rates than these types of lines of credit, especially if it's a unsecured product. So if you have a personal line of credit that's usually unsecured, meaning it's not tied to an asset in case you don't pay back the bank. Um, Whereas with home equity, it's secured by your home, meaning if you don't pay it back, they have the right to foreclose. So because it's tied to an asset that you have, anything that's really secured by something, right, is going to have a lower interest rate. And credit cards in general, although they're secured, most people have unsecured credit cards, meaning that if you don't pay back the credit card, they'll just ruin your credit profile or credit report or credit score, and then you just probably can't borrow money for a long time again. And that's why credit cards have higher interest rates because anything that's unsecured is going to have a higher interest rate. And even though a personal line of credit may be unsecured, it'll have a lower interest rate than a credit card. So a credit card, you'll typically see like, 22 to 30% interest rates, whereas with the personal line of credit, you may see more likely 15% interest rates. Um, so here's some disadvantages. Another disadvantage. So yeah, first the disadvantage is the credit card has a higher interest rate. The second one is that you don't have as much flexibility as what you can pay off. So there are some restrictions. So usually credit cards cannot be used to directly pay off another loan. So if you have a student loan, a mortgage, auto loan, you probably need to use an intermediary service like Plastic. I actually like to call it Plastique, but I think the official pronunciation is Plastic with a Q.com. Or another credit card, such as a promotional. I'm sorry, let me say that again. You cannot pay off directly another credit card either. So you can't, if you have a balance on American Express and then you're trying to pay it off with a Discover. You usually can't do that unless you get a once in a while, you get that offer from in the mail or in your email saying hey, you have a promotional balance transfer. And another thing to note that just if you, let's say, use an intermediate service like Plastic or a promotional balance transfer for maybe like 0%, there's always still a fee. They always charge like, I don't know, I think 3% of the amount that you're trying to pay off using the balance transfer or the Plastique. So you just kind of have to be careful with that. Now, here's the main advantage of why you would use a credit card. Um, Usually, if you pay off the balance in full, they won't charge you interest, or if you pay off, the balance in a certain amount of time, they won't charge you interest. So you have what you call a floating interest period. Really, really helpful for those who are responsible, and then you can also get like points and stuff. And so, um, again, there is advantages. The biggest disadvantage of the line of credit is at the moment that you pull out the money, that's when they charge interest, whereas a credit card, they do give you a little bit of leeway. And just be aware that if you want to find out the full terms of how much they charge, what the minimum payment is, always call the lending institution, because every lending institution is different. So for example, it's kind of like fast food. If I go to McDonald's and Burger King and Checkers or whatever, I know they all serve hamburgers, right? But the type of hamburger they sell will differ from restaurant to restaurant. And it's the same thing with credit cards, right? So, the type of credit card that Bank of America offers will be different from Chase, and their terms will be different, and probably other things like the floating interest period. So that's why it's very hard to make a sweeping generalization. It's like, oh, all credit cards are like this. They're very similar, but in order to find out the exact terms, you always have to call them. All right. So now let's go back here. So we're just going to do an example of velocity banking. And if you're unfamiliar with velocity banking, I recommend that you click the link below, go to Velocity Banking 101 to start off with a simple example of how to engage in it. But it's really relatively easy. There's 2 steps. If you don't want to go ahead and click in the video. First step is you need a budget, right? So here's the average American paycheck, 5,000. 3,000 expenses, 2,000 savings, and 0 in cash flow. And so once we've done that, we have our expense breakdown. So we have our expense breakdown here. So let's say this person is paying student loan, car loan, rent, and other things. Now, what's really important when you do expense breakdown is that every single debt that you have should be listed as its own line item. Never combine the debts. Other things you can combine, like the rent and the other, but everything that's an actual debt, you always want to put it in a line item, because every debt that we have eats up into our cash flow. Now, for this example, let's assume that we have a 25,000 credit card with that limit. And so we'll assume a 30% interest rate as well. Whoopsie. So now that's the second step. So once we've done our budget, now we use our tool, which is a line of credit. In this case, it's going to be a credit card, right? So credit card with the 30% interest rate. Now the concept is pretty much relatively the same. The only thing that we'll have to use to pay off loans is we probably have to use an intermediary service like Plastiq. And there are some restrictions on which cards you can use to pay what. I think if I recall correctly, 2 years ago, I used Discover to pay $5,000 off of my mortgage to take off the principal, right? So there's probably going to be a fee of I think it's 3%. So I'll say 3% fee of how much we decide to pay off with a loan. So the first step, well, actually, the next step in engaging velocity banking after we have our tool, which is the credit card, in case we can't get a line of credit, we just pay off and do a debt transfer of this to right here. So how much balance do we have right here? We have $23,000, right? All right, so now if we calculate the 3% fee, our balance is going to be a little bit higher. So we'll just say 23,000 times 0.03, and so that'll be an extra $690 off the top of it. So 690. Also, one other thing I want to mention is that sometimes credit cards do have promotional periods where they offer something called balance transfer or convenience checks. So that's basically inserting cash from the credit card, but be aware that they usually charge maybe like a 3% or 4% fee when you do that. So just something to be aware of with regards to your options credit cards. Now, so now let's take a look what happens right here once we do the balance transfer. So what happens is that when we transfer the entire balance, this goes away, right? So what happened to our expenses? Our expenses magically went from 3,000 to 2,000. Our income stayed the same. Now, here's what we're going to do a little bit different. So instead of having savings, because savings is just idle money, what we're going to do is we're going to use our cash flow, which is $3,000, so 5,000 minus 2,000, to pay off the balance of the credit card. And if you're not familiar with how velocity banking works, basically we're going to put our entire paycheck to this balance on the credit card, take out our expenses as needed, and then use our cash flow to bring the balance down to zero eventually, right? So all we have to do is just subtract 3,000 from the previous balance. And again, these are all estimations because credit cards and lines of credit use average daily balance to calculate how much interest you would pay. So, but we're just going to assume that after every month or so, we're going to pay but down $3,000. And then this would be zero, right? So how long does it take us to pay off the credit card? 1, 2, 3, 4, 5, 6, 7. So about 7 months. In order to calculate the interest, all we have to do, because they're basically taking the average of the daily balance of the previous month. But since we're not doing a thorough example of having average daily balance, we'll just make it easy for ourselves. We'll just assume that the average daily balance was the balance of the starting balance of the last month. So the way that we calculate the interest is the previous month, so H2, we multiply it by the interest rate, which is 0.3, that's 30%, and you always divide by 12. So if you're doing it monthly, right? So you're doing it monthly, make sure you always divide by 12. People get confused when they're quoted an interest rate because that's an annual interest rate. And usually when the bank or the lending institution calculates the interest, it's usually the interest rate divided by the number of days and the average daily balance. So we don't have the average daily balance. We're just going to do monthly. So divide by 12. And we'll see that in the first month, we'll have to pay about $600 to use that credit card. So I'm going to go down here, 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 here. We're just going to copy and paste the formula. So let's see how much time it took us to pay off the credit card. So F2, I'm sorry, I2. Okay, so it's I2 to I10. Okay, so now it took us about $2,000 or in interest to pay off the credit card, but we're able to do it within about 7 months, which is pretty good, right? So here's the thing. Ask yourself, for the average American, if they ever had, let's say, like a student loan or a car loan like this, would they be afraid to use a 30% credit card to pay them off? The answer is probably yes. But we're able to pay it off within 7 months, and all we have to do is pay $2,000. Now, would it be more ideal to use a cheaper tool such as a line of credit, like a HELOC or a personal line of credit, where the interest rate would be 10 to 15%? Absolutely, absolutely. But the idea is that you're going to use what you have. And the other thing to note is that banks only lend you money when you don't need it. So you're going to get as many tools as possible before you start using them. You don't ever want to try to apply for lines of credit when you have all these loans and you're drowning. So if the credit card is the only thing that you can get it. But if you have better tools that are more appropriate, such as the personal line of credit or the HELOC, use that because you'll pay you'll pay less, right? So I remember we did this in the Velocity Banking 101 calculation. This was about maybe $1,500, and we talked about using a 15% personal line of credit. This one's 30, so it's a little bit almost double. And as you can see, even though it's 30%, we're still in a good position. We paid off our loan. Now we every month we have now $3,000 in savings. Now a lot of people, they're a little bit afraid to have savings just because they feel like it's idle money, which is true. And so you just use that in an investment, maybe like a stock or a rental property. Again, not giving you financial advice, just giving you examples of what might be ideal once all these loans are paid off. But the average American doesn't pay off these things within 1 year. Certainly not possible. they're living paycheck to paycheck. In fact, I watch a lot of TikTok videos that have been appearing in my YouTube feed. You know how people repost TikTok videos to YouTube, and for some reason, a good number of them is just how people are drowning. So I think this is an easy way to kind of get out of debt, but also maintain your liquidity. So let's say I use that 30% credit card, and let's say in this month, right, like I need extra $100 of expenses. Especially if you're living paycheck to paycheck, that $100 is not available to you. Here, if you have $100 of expenses, you can usually use your savings, but people are always finicky about that. But especially if you're living paycheck to paycheck and you want to maintain your liquidity, you definitely have options here, and you're quickly paying off your loan. Maybe if your cash flow isn't as tight or isn't as good in 1 month, you'll be able to just wait another month to pay off the loan. Another thing too is let's say you're trying to pay off the loans here quicker, and you're dumping the entire savings directly into the loan, then your liquidity is gone. So I'd rather use a 30% credit card to pay off the loan quickly rather than using my savings to directly pay off the loan. Okay, so now we see how easy it is to do velocity banking with a credit card. We may pay higher interest rates. We may pay a 3% fee, but it's still the same idea, right? So we just put your entire paycheck here, subtract the balance here, right? Or subtract the cash flow, which is 3,000 after every month, and then also make sure that you get the interest, and then you'll see how long it took you and how much it cost you to pay off the loans earlier, right? Okay. All right, so this is Crain Atlanta Mentorship. If you have any questions, leave them below. If you're interested in joining our group, go ahead and click the About tab in the YouTube channel and send us an email saying you're interested in joining, or you could click the Google form link below. All right, have a great day, and we'll speak soon.